Signs of global stagflation remain. COVID resurgence is looking more likely, and bearish sentiment readings could still fuel a melt up in markets if tech earnings deliver. All this and more in this week's Macro Insight. So welcome everyone to Macro Insight. Today is the 26th of October, and let's take a look at these markets. So what happened last week? So the main things last week, we had a fair amount of data on the economic front. We had Australia and Japan and the UK. Manufacturing and service PMIs were picking up. But then on the flip side of that, we saw Germany and eurozone ticking down. So a bit of a mixed bag. We also saw Philly Fed in the US ticking down. So on the global growth data front, still yet to see reflation in Q4 being confirmed, right? So we're expecting to see a tick higher in those sort of economic data points, and we're not really seeing a convincing tick higher across the board as we would have expected if we were going to go into a bit of a mini reflation dynamic into the end of the year. You also saw Japanese PPI come out high, so plenty of signs still of stagflation concerns still being there on a global level. The Fed's Powell obviously spoke on Friday, and he's consistently been calling for inflation to be transitory, and even he started to change his tone and noting that supply side constraints have gotten worse. So, on the back of that, price action wise, what did we see? We saw US yield curves continue to bear flatten, which doesn't really bode well for the longer term growth outlook. So whilst people are bringing forward potential rate hikes that need to be done to keep inflation in check, they're borrowing those hikes from further in the future rather than just saying that's just going to be more hikes going forward. Okay, and basically what it's saying is that whilst we're going to probably have to get hikes, that's going to take the steam out of growth. So where are we seeing that in the curve? Obviously, the 30s and 5s continues to flatten. We have been saying that if we're going to own anything, we'd rather own the 30-year, the TLT type stuff. I think that's going to be relatively well supported on the back of all these potential growth headwinds that we're heading into further down the line, even if we get a short-term bounce in growth. And then also you're going to have longer term, you're going to have like Japanese buyers and things like that stepping in the long end of the curve where they're looking at relative yield differentials that they can get in treasuries relative to their domestic bonds, right? So that's the sort of stuff that's supportive there. If I share my screen, we've got to just see how dramatic the pricing has been in the likes of the front end of US yields. So you've got the June 22 euro dollars there. You can see quite a dramatic move there, pricing in an extra hike basically. And then the DEC 2022 euro dollars have collapsed by best part of 40 odd basis points. So kind of two hikes in there basically for next year, which was quite a significant repricing over the last month or so. Yeah. What else have we seen? So a lot of stuff on the inflation front. We've got CPI rents. So obviously we've been saying that whereas you had some of those more transitory parts of CPI that looked like they had peaked, like used cars and things like that, rents were going to come and take up the slack because house prices obviously had been screaming higher, and then rents tend to lag that. So we have seen rents really starting to go up, owner's equivalent rent. You see a significant uptick there. You've also started to see inflation on the wages, which, is arguably some people would think is a bit strange given the amount of job openings that we're seeing. But, clearly the data is showing us that there is pressure for wages to go higher. And what is that on the back of, right? So, there was a really good conversation between Stephen Van Meter and Darius Dale of 42 Macro on Real Vision. And I strongly suggest people who are kind of members there to check that out. But basically, they're talking about the fact that the job openings data arguably might be a bit bogus. So that a lot of companies have to put job openings out greater than actually what is reality, basically, right? So, and then on top of that, you've got a bit of a skills mismatch as well. So the people who are in the labor market looking for jobs may not have the skills required for those job openings, right? So that's partly the issue. You've also got an issue in that stimulus money that was given to people, rather than necessarily going out and buying a load of goods with it, they are using that money to buy time. They're using that money to buy time to not have to rush into a job that they hate. And that is creating this kind of shortage in labor, okay? Which I find that quite an interesting dynamic. And then, so whilst, you know, people say, oh, well, these people have not got stimulus checks anymore, they're going to have to go back and work. Well, maybe they've managed to kind of not spend all those stimulus checks immediately, and they're using them to kind of bide their time to not rush back to the labor force and wait for wages to rise to entice them back to the labor force, right? And that's the kind of stuff we're starting to see. On the top right chart, we're seeing global goods spending dropping off as obviously prices up. There comes a point where inflation is going to lead to demand destruction, right? And we're starting to see consumer goods spending drop off a bit whilst prices stay high. And then you've got the ECB in a bit of a pickle where, you know, their inflation rate, CPI, is like 5% above their base rates. This is something they haven't seen for God knows how long. So, you know, I think highest level PPI is in double figures, highest level since 1977. And the question is, you know, can the ECB really keep policy as loose as it is when you've got such a big differential there, basically, right? So there's going to be, we'll find out what the ECB says this week, but there's going to be some pressure on that front as well. So inflation pressures, we're kind of seeing them across the board globally in every direction you look. And I don't really see a lot of these things going away anytime soon, right? Because a lot of them are not demand-led. They are due to, you know, supply chain issues and what's going on in the labor market, etc. Okay. And then to make matters worse, COVID might not be done yet. So, you know, if we go to the next sort of chart of interest, you know, you're seeing spikes in cases across a bunch of places. And these are not necessarily places that are not vaccinated, right? So we've got numbers rising in the UK, Singapore, Latvia, Russia, all over the place. And obviously we're heading into the winter, so we're going to get colder weather. We're seeing clear evidence of vaccine efficacy waning, more lockdown potential, the potential for vax passes and mandates, which is, you know, which might be rejected by both employees, which we're seeing in the likes of some of the airlines, maybe in the US, and consumers as well. So you see, you know, restaurants in France, for example, or in New York City that are requiring people to show passes are getting less customers, basically, right? So all of these things are going to potentially be a drag on growth and on activity going forward, okay? Now, cases and deaths are obviously near records in Russia. There's an outbreak in China that apparently is set to worsen, according to officials who've then gone and reimposed travel restrictions internally in China. Yeah, so definitely a bit of noise on the COVID front popping up again. I'm not quite sure we're done yet with that. Okay. And then despite increasing numbers in the UK and, you know, a call from various people, advisors, whatever, saying that UK needs to impose Plan B restrictions, they're kind of holding off for now because they're saying that the data doesn't really warrant it yet. Because if you look at death rates in the UK and then we look at the right-hand chart, they're not really going up, right? So arguably the likes of Latvia, for example, where deaths are exploding, have imposed a bunch of harsh restrictions again. The UK seem to be, for now at least, doing their best to look at death numbers. And if they're not exploding, then we don't necessarily need to go into lockdowns again. So we'll see what happens, right? Fingers crossed, you know, they're not going to cancel Christmas again, right? We're all hoping that. So anyway, so this is kind of the stuff that's on my radar as not so positive and not so optimistic, basically, right? And I think that whilst for now, the market seems to be shrugging it off, clearly, I think it's something we just definitely need to keep an eye on to see if it gets any worse. Now, if we look at the S&P, now let's be clear, the melt-up risk is very, very real. Okay, so Goldman's love to point these things out, but they're generally kind of a bit more bullish. But bearish sentiment is still definitely around, and you can see that in this chart. So whilst markets are overbought, probably on a week, on a very short-term basis, if we're looking forward into November and December, look at the sentiment indicator, right? This sentiment reading, is nearly 1 standard deviation negative. That's how bearish discretionary people seem to be. Okay. And then on top of that, what have we got going on? We've got relentless buying flows for the more systematic buyers that are out there. So CTAs have been buying approximately $10 billion of global equities per day. Corporates via buybacks have been buying, about 4 billion per day. Retail has been piling in and buying 5 billion per day. So that's looking at 18 to 19 billion worth of global equity demand per day of the past week. And the Goldman's guys are expecting to see more of the same this week, right? So you're definitely seeing those flows despite quite bearish sentiment. And then the marginal buyer, as we said, is always the buyback bid, right? So this chart on the right is showing you the buyback blackout, which was covering more than 80% of companies. That's rolling off. Right. So once we get into early November, that completely drops off and all these companies are free to buy back again, basically. Right. So definitely, if we get a dip, if we're lucky enough to get a dip this week on the fact that things are a bit overbought and frothy and tech earnings maybe disappoint at the margin, which they don't tend to do, but let's see if they manage to this week. If we do get a dip, then it's probably a good opportunity to buy into November, given that backdrop. Right, given that systematic buying backdrop, basically, and that more price insensitive buyer that's out there. And then what else? So then what we got coming up this week? So it's a massive earnings week. Obviously, mega cap tech is the main feature that everyone's going to be looking at because there's such big weightings. But today you've got Microsoft and Alphabet or Google. You've also got Visa. So those are the big ones. General Electric as well, AMD. Wednesday, you got Boeing, General Motors, and Ford. Also, Spotify on the tech side. Lots of other names scattered around. Banco Santander, big financial there in Europe. Thursday, you've got Royal Dutch Shell, obviously big oil name. Apple, Amazon, MasterCard, Caterpillar, those sort of names reporting on Thursday. And then on Friday, BNP, Daimler, Merck, ExxonMobil, Chevron, big oil names again. So lots and lots of earnings to kind of keep an eye on there. Often in earnings season, when you've got so many companies reporting, the broader index doesn't kind of do much and it's all about dispersion as the single stocks are the ones having their moves. But because we've got tech being such a big weighting these days in the major indices, if you do get a consistent message coming out of the big techs that they're priced for perfection, then maybe we get a bit of a pullback, right? But like I say, these tech companies seem to have an amazing ability to beat earnings consistently, no matter how high the stock or how high the earnings expectations, right? So I'm not overly holding my breath on that. Okay. And then on the macro data front, we've obviously got some consumer confidence out of the US today. Australia have got some CPI data. We'll talk a bit about Aussie in a minute. UK have got their budget. Bank of Canada meeting on Wednesday, durable goods out of the US on Wednesday, ECB meeting on Thursday, German CPI and US Q3 GDP, which will be interesting. And then on Friday, you've got industrial production out of Japan, some retail sales out of Australia, PPI. Germany have got some GDP data. You've got PCE inflation out of the US and University of Michigan sentiment data in the US. So pretty heavy week on the earnings and also a fair amount of macro thrown in. Yeah. Okay, now if we go and talk about FX and what's been going on in FX. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.